I'm Andrew Samalin from Samalin Wealth. The comparison between the dot-com era and today's AI boom is a big topic for investors today. There are clear parallels, but there are also critical differences. The central question is whether today's AI spending will generate enough profits to justify trillions of market value, or whether we are repeating the same mistakes from the dot-com era in the late 90s, which can have substantial impacts on global financial markets, the U.S. economy, and more importantly, to you and your finances. So let's compare those two eras and gain some insight into what happens next. The dot-com era began with a massive spending on infrastructure. Investors assumed demand would grow indefinitely. Valuations expanded. Excess capacity developed. The market then collapsed by 80%, and long-term winners emerged into the next decade. The AI era is following a very similar path. And during the late 90s, companies spent hundreds of billions of dollars building fiber optic cable, internet backbone, data centers, networking equipment, and servers. Companies like Cisco Systems and Lucent and Nortel Networks and WorldCom all experienced explosive revenue growth because everyone was buying infrastructure. And that's happening today as well. So what's the problem? Well, companies weren't generating enough revenue yet. Demand eventually arrived, but it was 5, maybe 10 years late, meaning the infrastructure was built far faster than the monetization, and stocks collapsed as a result. Today's spending looks extremely similar, except that it's much, much bigger, although there is some revenue against it. Large tech companies are investing hundreds of billions of dollars annually in GPUs, AI chips, networking, massive data centers, electricity generation, fiber, and connectivity. So who's spending all that money? Well, it's Microsoft, Meta, Amazon, Alphabet, and Oracle. And who are the beneficiaries? Well, we hear them every day, and the stocks have done very, very well. The suppliers of that hardware, which are NVIDIA, Broadcom, AMD, Micron, etc. So just as Cisco sold the picks and shovels during the internet build-out, well, NVIDIA is selling that again today for the AI theme. Investors ultimately don't care, though, how much an AI company spends, but they really care about whether every dollar invested produces profits. And for multi-trillion-dollar companies, you need a lot of profits. And that's where the concerns begin. During the dot-com era, capital spending was enormous. Returns on invested capital were poor. Investors asked, well, where are the earnings? Stock prices collapsed. They went down 80% in 6 months, and they stayed there for a decade. Today, the equivalent question is being asked. Companies are spending unprecedented amounts of money in the trillions. Can these companies generate enough subscription revenue or productivity gains, enterprise software sales, advertising revenue, automation savings to justify what might be a $7 trillion spend over the next 5 years? And the question isn't whether or not AI has value, but will the economic value be large enough to justify the spend? Back of the envelope math, $7 trillion build-out times a 20% equity return equals roughly $1.4 trillion in earnings required to justify the spend. The total earnings for the Mag 7 in 2025 was about $500 billion, which means that even assuming every dollar of earnings went towards the AI build-out ROI, they'd be $1 trillion shy for just the earnings hurdle rate. And we're going to need a bigger boat. Another meaningful difference between then and now is that in the 90s, there were relatively few mature business models. AI already has significant commercial use cases, including software development, customer service, drug discovery, legal research, cybersecurity, enterprise search, content generation. So there are revenue sources here. And also, unlike the dot-com era, today's largest investors are among the most profitable companies ever created. Now, keep in mind, these companies were profitable before AI, not because of AI. So how are they paying for the build-out? Well, dot-com companies often relied on debt financing, and when that revenue didn't materialize, the debt service wasn't met and they went bankrupt. Today's hyperscalers generate operating cash flow to fund their investment internally, or at least they have. However, given the size of the investment needed to stay competitive, they are using all their cash to fund it. As a matter of fact, Google just resorted to an $80 billion equity offering by selling stock. And they have also started to use debt, which is something to look at. The historical lesson from the dot-com era is not that transformative technologies fail. It's that technology adoption and investor returns often follow different timelines. The infrastructure can prove indispensable, while the companies that built it or the prices investors paid for them could also disappoint in the short term or the medium term. And this makes sense too. Look at the railroads. They changed our country, but yet they were riddled in bankruptcies and they went down 90% in the Great Depression. Automobiles in that same boat. It changed our world, but 3,000 car companies went out of business, even though you have a couple of them in your driveway. The dot-com era, hundreds of bankruptcies, but we can't live without the internet in any way, shape, or form today. So there's really no question that AI will change the way we do business. But the part that makes me nervous, frankly, as an investor and an investment advisor, is how much AI-related stocks are represented in the S&P and how they are valued. They make up over half of the S&P market capitalization, which means if AI profits don't materialize or they're delayed, the S&P can suffer meaningfully, potentially for years, if not decades. Let's look at this through the other end of the telescope. If AI truly creates profits over time, we might consider focusing on the beneficiaries of the technology as opposed to the creators of it, meaning of the 500 companies in the S&P, should one invest in the 10 or 20 mega cap companies that create the technology directly, or should we simply invest in the other 480 companies that will benefit from all that work, from all that investment, and from all of that risk of success? That could allow us to enjoy the gains that AI is supposed to be creating, all on someone else's nickel. And by the way, that mindset doesn't devalue AI or minimize how revolutionary we all think AI could be over time. It simply helps us manage the risk of these profits not materializing in the short term. So just as the internet changed the way we do business and live our lives, AI will become a multiple of that. Let's close this video by looking at this from a personal level. The dot-com era created the internet as we know it, but it took 20 years from the peak of that investment for it to really work. Cisco was the largest and most profitable of the dot-com companies. It was in every single portfolio and every single mutual fund, but yet it took 25 years to regain its old high. So take your age, add 20 years, and if history repeats itself, that's how long you may have to wait for these security prices to come back. And we know what happened to Nortel or WorldCom or Lucent. Now, this bull market can continue for years, right? What if we're in the equivalent of 1996? That market did not peak for 4 years after that. So this does lead to some very interesting individual choices. Do you want to assume that risk? Can you afford to take that risk? Should you take that risk? How much risk should you take? Now, you can control that exposure and that risk as an investor. And we can talk about that as to how to achieve that. And as a client and friend of the firm, we can review how to do that. Thanks again for watching. I'm Andrew Samalin, and see you at the next update.